Ways to get paid. So there's so many ways. I want you to remember there are 9 ways to get paid if you are a business owner. So number 1 is salary. Number 2 is contractor payment. Number 3, K1. Number 4, 1099 dividend. Okay. Then number 5, loan from your business. Number 6, reimbursement by your business to you. Number 7, company paid benefit for you, for your future. And number 8, pay back loan to company or capital draw. Means that you're going to draw your capital out tax-free, right? And the vendor payment, and pay you as you are a vendor, like you are Walmart. And you just write a check for yourself, and it's sort of like reimbursement or can be a vendor payment. Means that you may be another company that you can write check from your company to your company and to yourself. So these are 9 quick ways. The other thing I want to mention that there's 4 regular business structure, right? You either sole proprietor, you file yourself under 1040, or you are a partnership, you file 1065 tax form, or S Corporation 1120S or C Corporation 1120. I didn't list 990, which is the non-for-profit organization, but these are regular small business structure. So out of these structures, there's different ways. The 9 ways, I break that into these 4 type of structures. Let's go through that quickly. So proprietorship, right? You do that on Schedule C. And also that's including Schedule E as well. If you are doing rentals on your under your name and you file Schedule E and you are an active real estate professional, so you are also doing a business there. So whatever you have, this is the key, whatever you have left in your bank account, because you have a sole proprietorship, so this is really your personal bank account plus the business activity, that is what you can write to yourself. Because it doesn't matter, and you write yourself 0 or you write yourself the balance, you already pay taxes for it. You know, these kind of structure, they don't really save taxes for you. Whatever you made is pays taxes immediately. So that's why it is important to know that if you have a sole proprietorship, your bank balance is really what you can write for yourself. You don't want to. The next one is the other ways. You also can do a W-2 for yourself, but that really is sort of like it is unnecessary, right? Because your Schedule C, whatever left on the profit is like your W-2. You are already paying Social Security Medicare on it, so you don't need to do a W-2. But if you want, that's fine. And 1099, same thing. And you don't need to do that because you are already paying for it. Reimbursement from the company, sure, why not, right? If you spend a bunch of money to buy supplies, but that supply is really for your business, then you want the business to reimburse you. That is non-taxable, so you can definitely do that. And the company paid benefit, sure, if you are under Schedule C, you can pay to your solo 401k. These are money you take out for yourself, but no taxes for yourself, and the business can deduct their income tax. Of course, vendor payment. Say if you have a Schedule C business, but you also have another business which is not Schedule C, say S Corporation, then of course Schedule C can pay to the S Corporation for the services S Corporation provided to the Schedule C. All of these money back and forth and how to best utilize your tax efficiencies. Let's talk about the other structure, partnership. When you are in the partnership, Joe and Francis, you know, these 2 characters are in my first book, Appointment with Ying at 8 a.m. I actually this is real stories, but of course I kind of used phantom names, but they're real story. So there's these 2, they got paid differently. So because they have a partnership, the partnership can be structured by 3 major elements: the income, the expense, and the equity. So Joe and Francis, their equity is 50-50. What that means is if they sell the partnership, whatever they sold, the money they made on the selling is 50-50. But the other one is profit. When there is a profit, and Joe will get 10%, and Francis will get 90%. Because Francis is the one working the labor, Joe was the investor. But when there is a loss, Joe will get 90%. Francis will get 10% because Francis don't have a lot to write off. But if Joe has a loss and he can offset some of his capital gains. So these are the structure was flexible in the back end. And when you have a partnership, to pay yourself properly has a lot to do with that operating agreement. You need to set it right from very beginning. So generally speaking, there is 5 ways in the partnership people get paid: salary, guaranteed payment, capital draw, reimbursement, and K1 disbursement, K1 distribution. Okay, that's the right word to say. So these are, the guaranteed payment is worth mentioning. So if you have a partners that everything is equal, say you just did operating agreement from profit, loss to equity is all equal. And then obviously one partner works more than the other one. Then you want to reflect that either on the W-2 or on the guaranteed payment. You don't have to do W-2 at all in partnership. You need to show that as a guaranteed payment so you pay this partner properly based on the amount of work he did. Guaranteed payment, it goes to the partner's 1040. The partner would pay Social Security, Medicare on that as well. So capital draw, you can draw that free when you have the basis, but once over the basis, you are capital gain, right? So with reimbursement, that's very easy to understand. If one partner spent this money for the company, of course the partnership should reimburse. The other partner also can reimburse what he spent. So a fair game when it comes to spending money for the partnership, everyone can get reimbursed. And in the case where it's also in my book that if the partners doesn't have equal economical lifestyle. So what we recommend in that case is that the partner don't reimburse that kind of things inside of the partnership, but bring that into their 1040. In their 1040, there is another schedule to support the partners. You can deduct all your expenses for the partnership, but was not reimbursed by the partnership. It's a supplemental income and expense sheet, so it is inside of your 1040, inside of your Schedule E. So I just want to mention that so you know where to find it. And on the partnership, of course, these are additional things you can do. You can do company paid benefit, same thing, just like how you were doing on Schedule C. And you can also run 1099 payment loan from the company, which is tax-free if you do loan. But if you do loan from the company, from the partnership, you want to make sure that you have this minimum interest imposed because it has to be look like a loan, behave like a loan, right? You can't say it is a dog, but it's a puppy running around. So you want to make sure that you follow the guidance to do those loans to the partners or whether it's to the owners. Next one is the third one is S corporation. S corporation is the most popular small business entity right now out there. So remember, S corporation requires payroll and also has this thing called a reasonable payroll. The IRS understand some of those shareholders, they simply just don't want to run payroll because they don't want to pay Social Security, Medicare. Everything went through K1 distribution. That K1 distribution do not subject to Social Security, Medicare payment when it landed on your 1040. That's why it has become an area where a lot of tax savings was coming through. So if it was not planned properly, people could not realize they need to do W-2 but run away with the distribution. That doesn't work. You have a lot of tax court cases out there. So the distribution part, the K1 part, has no self-employment tax. That's why significant tax saving strategies for many businesses. Each share of stock gives the shareholder equal right to the retained earnings, to the distributed total. The distribution of the retained earning is determined by the number of shares owned by each shareholder. So in S corporation, it's a little different. Actually, it's a lot different. But in S corporation, as a corporation, it is only one ratio determines everything. So that ratio is the shareholders. What percentage you are, 50-50, then everything about shareholders 50-50. So there's no difference between profit and loss and equity. So that is something we want you to be aware of, that there's no flexibilities like how the partnership has. Then, of course, for S corporation, you also have other ways to pay. You can pay yourself 1099. And let's say you run yourself a payroll, and then your payroll, you are managing the company, but you're also a graphic designer. So whenever you design something, that would be a 1099 payment because the nature of service is very different. You can also loan money from the company, which is non-taxable. You also can get a reimbursement from the company, which is non-taxable because you spend money for the company. Now the company pay you back. That is not taxable. But company can deduct that as expense. Of course, company can pay benefit like the $23,500 on solo 401k I was talking about, you're entitled to. And you can also develop profit sharing 401k inside of your S corporation, match 25% of your gross salary at the end of the year. Put that into your retirement account and reduce that out of your S corporation income. The key is to have those elements all in. So for example, the maximum 401k contribution is the self-deferral plus 25% of your gross salary. And you can easily get to $60,000, $70,000 a year on that saving, and you don't have to pay taxes on that. Of course, you can always pay yourself back from the loan you loaned to the company. So that's tax-free as well. Of course, vendor payment. If you have other company that you own, and this company need to pay services fee to the other company, then you have a vendor payment, just like how you pay Home Depot, how you pay Walmart. Our last one is the C corporation. So C corporation is kind of the company that President Trump has declared 6 times on bankruptcy. So obviously, you know how wealthy on the personal side he is. So 6-time bankruptcy on C Corp, it didn't create any problem with him. So that tells you the separation. Just like he said, he knows how to take advantage of the taxes. So this is where we always want to tell folks that if you are operating a risky business, for example, you are running a bar, that's risky business. People get drunk and things can happen. So, you don't want your personal stuff to be related to that. For President Trump, he was running gambling ground. And so that's why it's a C Corp, right? So anytime when you run things that risky, where you don't know whether financial gain is really guaranteed, then that really should be a C Corp. Inside of the C Corp, you only got 2 ways to get paid. Number 1 is you pay yourself as an employee. Number 2, you pay dividend to yourself. The company made money, you pay taxes, and then you pay dividend. This is where folks talk about double taxation, because you paid 21% on the corporation tax, then you have dividends, and when you distribute that to yourself, and it become dividend tax on your 1040, right? But I still say that folks don't get confused with your C corporation versus what you see on the internet. A lot of those C corporations are public companies. And when public company is running their business, they have to pay dividends to their people, to their shareholders that they bought their stock online and stuff like that. So they are required to pay that dividends often to even keep the company afloat, keep the company momentum going. But when you are privately held, closely held business, it is your company. You decide on when and how to pay dividend, and you decide on how to spend your money. So if you really had $1 million dividend in your company, and I would already start looking at how to invest. And we have so many ways we can talk about how to invest inside of C Corp. That could be a separate webinars. I don't think we really specifically talk about how to invest in a C Corp, but C Corp is the company that can do everything within themselves. C Corporation is also a corporation that allows the foreign investors and the foreign owners in the structure. So giving that thought, it is a pretty dynamic and a pretty flexible and can have a lot of in-depth application with the C Corp. Type of dividend report on the form of 1099 DIV, that is the dividend that come out of your form. So most of domestic company, like company operating in U.S. and producing in U.S., those domestic company, and when you distribute dividend, not only is an ordinary dividend, it's also qualified dividend. So there's different type of dividend you issue. So when you issue the dividend, you can consult with your CPA firm, make sure that the dividend issuance is proper, because those are dictated to how tax is calculated on your 1040. So it is not just a dividend. The dividend has qualified and ordinary dividend differences as well. So many business owners are not doing dividend distribution or dividend treatment often enough. They wait until the moment they want to close the company, then they go, oh no, I have $1 million dividend in there. I didn't know I have it. So those are the things your financial statement always presented to you that way. It's just you were not being told. So if you have a C corporation, I would invite you to look at your dividend frequently to sort out solution for it. Because a lot of times it's really difficult for anyone to come in to resolve that in that year for you. But if you look at it very often and understand it's going to trigger taxes eventually, treat that as you go and you won't have that issue. So making sure that you don't end up in the double taxation situation. This is your own company. You should be able to just evaluate that and get that done. So of course, there's also other ways to get the money out of your C Corp. So these are the way I listed. And you can pay yourself 1099 if you are providing different kind of services on your own. Then you take your 1099 to your 1040 Schedule C. Then you ended up paying taxes over there. But 1099 payment come out of C Corp is expense. Then loan from company, again, if you do loan, that's fine, it's non-taxable, but you want to make sure that you have a repayment schedule and you follow through the rate that IRS allows, so making sure that you do it properly. Reimbursement from the company, of course, that's straightforward. You can reimburse mileage, you can reimburse different things that you spend personally for the company. Of course, company paid benefit, that's huge as well, and you can literally bring in your 401k profit sharing plan, and you can also develop pension plan for your company executives or for you yourself and for your employees, however you choose, right? So those are the things can properly put away money in a separate account, not paying taxes, but allow people to take that amount when they retire or in the future and to pay taxes in the future. This is the form that I want to show you on the 1099 dividend. This is related to the C corporation, right? So C corporation, like I said, this is the second way people has to deal with. As long as you have a positive retained earning, you have to figure out whether to issue 1099 dividend or you actually use the money inside of your C corporation wisely. All right, so this is our website, communitycpa.com, and you notice that we have this On Board with Us button. If you click that button, and you will sign up with us 24/7, whenever you have time, through this button, then we will get back to you and get you connected with the right team member to help you out. So we have 6 partners, 2 managers listed on our website. 6 partners were all in different area of practice. So Dr. Howe and one of the partner, and he is legal compliance and the immigration side of work. And Dan Kim another partner. He's in charge of client service of market development. Juan, specialty in payroll accounting, sales tax. Song, he is our attest partner, handles audit. And Derek is our IT network architecture and IT partner. Tiffany is our tax manager. Eileen is our accounting and audit manager. And this is YouTube channel. We always deposit all of our webinars into here. And I hope that you will subscribe to our channel so you always get notified what we have for you next. And also, if you like our video, give a thumb up. Last, no responsibility disclaimer. Of course, all our webinars are for educational purposes, and it is not the tax, legal, accounting advice, because those advice need to give to you customized. We need to know who you are before we can finalize what is the advice. And be sure to review any decision with your CPA, your attorney, your tax advisor, or with community CPA before you put that in action. All right, I'll talk to you again